Good morning, good afternoon, and good evening to Dr. Afiandi as my bachelor thesis supervisor and to the bachelor thesis examiners who are watching this video. Allow me to introduce myself. My name is Rafi Renardi Sugiono from the accounting department, and I would like to present the result of my undergraduate thesis with the title of Analyzing the Application of Tax Planning to Minimize Income Tax Burden, a case study on PT Kartik Express Nusantara or PT. So there are five parts of this thesis. The first is introduction, then theoretical basis, research methodology, research result, and conclusion and advice. First is the introduction. So for the background for this research is that for companies, tax management is important as high tax burdens can be seen as high burdens, which prompts the companies to perform tax management. Tax management helps with minimizing the company's tax liability, ensuring legal compliance, optimizing cash flow, and enhancing profitability. The first step in tax management is tax planning. Effective tax planning can positively impact a company's net income and long-term success. With the importance of tax management and tax planning in mind, the researcher seeks to answer the question, can tax planning help in reducing the tax burden a company must bear? And is there a difference in the amount of taxes owed to the state when the company does tax planning versus when they do not? The objective of this research is to prove that tax planning can help reduce the amount of tax owed to the company and to prove that there is a difference in the amount of taxes owed to the state when the corporation or the company does tax planning versus when they do not. The researcher hopes that the uh, thesis can contribute in two aspects, theoretically and practically. In the theoretical aspect, the researcher hopes that it can provide information to writers and readers who want to broaden their understanding and knowledge of tax planning applications in businesses. For future researchers, this can serve as a reference for further research on tax planning application on lowering income tax in companies. And from the practical aspect, this research is intended to offer feedback to the company and insights regarding the use and benefits of tax planning in decreasing the tax burden. Now, next is the theoretical basis. For the theoretical basis, there is three that we will discuss: tax, income tax, and tax planning. Tax is the public's obligatory contribution to the state treasury as mandated by law. Tax is grouped into several categories by its type, which is direct and indirect tax, by its nature, subjective and objective tax, and by its collection agency, which is central and local tax. Next is income tax. Income tax is a tax levied on tax subjects based on the money they make or receive in a given tax year. The tax object is income. An example of this for companies being operating profit. Income itself is defined as the additional economic capacity that the taxpayer receives. And for companies, the income tax rate, as stated in Article 17, is 22% currently. Now, and next is tax planning. Tax planning is the ability of companies to plan and structure their tax affairs, involving a range of mechanisms to reduce tax legally. Basically, it is the first step in tax management, allowing businesses to restructure tax affairs to reduce tax obligations while remaining compliant with the law. The goal of tax planning itself is to reduce tax burdens a company must pay to the government. Next is the literature review. There are a few works that have been done to discuss this topic. The first is by Giulianti, who found in 2019, who found that the company of PTPN4 was not able to make use or implement tax planning, resulting in an increase in its tax payable. Next is Triwahyu Eka, who found that with tax planning application, PTPN4 was able to reduce their tax liability. And then Sabayang in 2013, who found that the application of tax planning in PTPN3 was not effective because several policies classified some accounts as not can classify some accounts to be unable to be deductibles, which meant that they are unable to be classified expenses. Next is Primbano et al. Who found that CVs in Bengkulu and Lubuk Linggau City were reliant on tax authorities to prepare their corporate income tax reports. Dyings, who found that the income tax article 23 calculation using the gross up method created tax savings for the company. and Rasidin Sulaiman in 2023, who found that Kopete Golden Rooster had not been able to maximize their tax planning applications, especially concerning income tax, which resulted in an increase in tax burdens. Next is the research method. So the type of research that would be used in this research is descriptive research, which aims to describe the facts regarding the research object accurately. The variables in this research are Petechen's income tax burden, which is described as tax levied on income or companies residing in the country or overseas, and the company's tax planning application, which is described as an effort to reduce the tax burden while still complying with tax regulations. The data used is primary and secondary data gathered from observations and the company's profit or loss statement. And the data collection methods used are observations, documentations, interviews, and literature reviews. And the data is analyzed using the descriptive method and the comparative method. The data was gathered by assessing the outcomes of field interviews and field observations. The data gathering process is also carried on the Petechen financial profit or loss statement, fiscal financial profit or loss. After the data is collected, it would be examined, and then the conclusions will be drawn from the examined data. The comparative method also involves drawing conclusions from observed facts by comparing the theories with the events that happen on the field. As for the variables, again, the dependent variable is income tax burden, and the independent variable is the tax planning application. Next is the research result. So as we can see here, this is Petechen's fiscal profit or loss statement for 2023 before the tax planning application. Revenues for the company amounted to 19 billion rupiah. Direct costs amounting to 12.8 billion, which results in a profit of 6.9 billion. The operating expense for the year was 3.7 billion, which results in a gross profit of 3.2 billion. The other income or charges totaled 291,000, which meant that income before tax resulted in 2.9 billion. The income tax expense itself is 578 million, which results in a fiscal income of 2.4 million for the year. So to calculate the income tax burden for tax planning, we follow this. So Petechen's income tax first is we first calculate the taxable income with facility, which is found by dividing 4.8 billion with the total revenue for the year times the income before tax burden, which results in 722 million. Next is the taxable income without facility, which is the income before tax deducted by the taxable income with facility, which results in 2.2 billion. Next is the corporate income tax payable with facility. So the formula here is 50% times 22%, or the income tax rate times the taxable income with facility, which results in 79 million. Now this is 50% because if a company's revenue is below 50 billion for the year, the company receives a facility for their income tax, which is a 50% deduction of the tax rate as mentioned in Article 17. Next is the corporate income tax payable without facility, which is found by multiplying the income tax rate with the taxable income without facility, which results in 498 million. And then the corporate income tax payable total is found by adding the corporate income tax payable with facility and the one without facility, which results in 578 million rupiah. So the income tax burden for Petechen for the year is 578,614,903 rupiah. Now, certain tax planning applications can be used by the company to reduce this amount. The first is to impose income tax Article 21 on commissions fee. By subjecting the fee amounting to 43 million to Article 21 tax cuts via the gross up method, it can be considered deductible, this one. Second is allowance for Article 21 salary, providing tax benefits through the gross up method so that the salary allowance amounting to 211 million can be added to the salary accounts, thus making it deductible. So previously, the company pays their employees a salary on a net basis. So under Article 4, it is not considered deductible. In calculating the gross-up method, the company will provide the tax benefits first before the tax deductions are made, and then the tax benefits are then added to the payroll. Third is pension fund. By including its employees in the pension fund approved by the OJK, or the Financial Service Authority, the amount of 217 million can be considered a deductible. Fourth is representation costs. By providing a nominative list, the company can list the cost of 62 million to be a deductible. And finally, allowance for doubtful accounts. Since doubtful accounts are expenses that have not happened, they will be subject to positive fiscal correction. However, uncollectible receivables can be considered deductible if the company submits a collections case regarding the uncollectible receivable to the district court. Now, so the analysis of tax man applications, we see the comparison of some costs and expenses before and after tax planning. For first risk return on commissions, before it was positively corrected, and then after tax planning, the amount is 44,131,282. This is found by multiplying the gross income previously, the 43 million, with 50% times the Article 17 tax rate, which was 22%, results, and then you add that to the original amount, which results in 44 million. The other direct costs did not change. Other direct costs is 12 billion. So at that and before tax planning, the total direct cost was 12.8 billion, and afterwards it became 12.9 billion. Now, in operating expenses, as you can see, the salaries amount increased by the allowance amount that was previously shown, 211 million, which means that the new salary amount is 2.8 billion. Post-employment benefit becomes 217 million. Representation cost becomes 62 million. Allowance for doubtful accounts become 887 million, which means the total operating expenses for the year is 5 billion. 88. 5 billion. So we can now compare the fiscal profit loss statement before and after tax planning. Before, the revenues did not change. Direct costs increased to become 12.9 billion. The profit decreases to become 6.949 billion from 6.993. Operating expenses increased from 3.7 billion to 5 billion, which means the gross profit will be reduced from 3.2 billion to 1.8 billion. And since that happens, the income before tax is now reduced to 1.5 billion from 2.9 billion. Now, to calculate the income tax after tax planning, first we go through the same formula. Taxable income with facility results in 378 million. Taxable income without facility, which is 1.190 billion. Corporate income tax payable with facility, which is 41 million. Corporate income tax payable without facility, which results in 261 million. And so the corporate income tax payable total is 203 million rupees. The income tax burden after tax money for Pete Chen is 303,480,994 rupees. As you can see in the corporate income tax payable, the difference between before and after tax planning. Before tax planning was 578 million. After tax planning, it became 303 million, which means that there is now a difference, or the company has managed to create tax savings amounting to 275 million rupees. Last is the conclusion and the advice. It can be said that Pete Chen did not use, for the conclusion, it can be said that the Pete Chen did not use tax planning measures which increased the company's income tax burden owed to the state. Implementing these tax planning applications can greatly help Pete Chen reduce its income tax burden, and the results of the tax planning implementations can result in tax savings up to 275 million rupees. So for the advice, the company can make several changes to its policies to avoid fiscal correction on certain accounts. These accounts are subjecting return on commissions to Article 21 tax cuts, providing tax benefits for Article 21 regarding employee salaries, delegating pension fund management to OJK-approved pension funds, providing nominative lists for representation costs, and filing a collection case to the district court regarding the company's uncollectible receivables. And the second advice is that Pete Chen should anticipate the introduction of new tax rules and regulations, which will be subject to frequent changes. The company should stay aware and adjust its tax planning tactics properly to ensure tax compliance and to be able to optimize the tax benefits. Thank you for your attention. Wabillahi taufiq walhidayah. Wassalamualaikum warahmatullahi wabarakatuh.